Hello, everybody, and welcome to Zeifmans Presents Non-Resident Digital Event Series, Part 4, Real Estate Edition, Builders, Developers, and Investors, presented in partnership with our NEXIA International Affiliate, Saffery Chapter. I am Kelly Bird, Marketing Manager at Zeifmans. And before we begin, I'm just going to walk you through a few housekeeping items. First off, feel free to ask questions throughout in the chat box located in the lower left-hand corner of your screen. In the participant feedback, we will try to answer as many questions as we can at the end of the presentation. If we do not get to your questions, we will follow up with you directly afterwards. In addition, you will be receiving a copy of this recording post-event, as well as the copies of our recorded interview sessions we are hosting after this as well. And with that, I would like to tell you a little bit about NEXIA International. So NEXIA International has 700 offices around the world. They're ranked as one of the top 10 global network of independent accounting and consulting firms. There's over 3,400 global partners, and we're globally connected to over 120 countries. So a little bit about Zeifmans. Zeifmans is a full-service accounting and consulting firm based in Toronto, Canada. Our services include business advisory, evaluation, corporate finance, transaction services, corporate turnaround and insolvency, and estate and succession planning. And a little bit about Saffery Chapter, our NEXIA International affiliate in the UK. They've been providing clients with outstanding service for over 160 years. Their services include business advisory, audit and assurance, tax and accounting, VAT, corporate finance, outsourcing, and trust. Their team comprises over 90 partners, directors, and over 800 staff across 14 offices. And now I'd like to introduce you to one of our first speakers of the day, Adam Kay, who's a partner at Saffery. Adam is a partner in the Transaction Tax Department of the London office. Although he advises on all tax matters, he has a particular expertise in advising UK and non-UK companies looking to reward key UK employees with equity and share options, raise equity investment under the Seed Enterprise Investment Scheme, and restructure, merge, or demerge their operations in a manner which is efficient for the UK tax purposes. And now a little bit about Sean, who is also a partner at Saffery. Sean leads their VAT team in the northern region and is headed up the firm's real estate group. He has experience of advising in a range of sectors, including property and construction, where he regularly advises on land transactions and commercial, residential, and mixed-use developments. And now I would like to introduce you to David Posner, a partner at Zeifmans. David joined Zeifmans in 2006 and became a partner in 2016. During that time, he has amassed a wealth of knowledge and experience in Canadian taxation in many industries. He also is a champion of our real estate industry group. And our final speaker of the day is Nathan Jung, a tax director here at Zeifmans. Nathan is a member of the tax group at Zeifmans. He specializes in Canadian corporate and personal tax and corporate reorganizations. And with that, I would like to pass it over to our first speaker, Adam from Saffery.
Thank you, and good morning or good afternoon, depending on where you are. My name's, as you know, Adam Kay, and I'm going to be talking a little bit about some of the UK tax issues which can apply to non-residents who are seeking to invest in real property in the UK. I'm going to be covering UK corporation tax, what we call stamp duty, which is a transfer tax, and some personal and corporate tax issues like inheritance tax and stuff like that. And then Sean is going to be covering VAT, which is our sales tax. Already, I can see that I've managed to work slides effectively, which is excellent. And so, where an individual or a corporate is looking to buy and hold property as a non-resident, actually the tax issues which arise to them are very similar to those which arise to UK residents. But in the past, it used to be different, and offshore holding structures for UK for UK property were very popular and very tax efficient, and now a lot of those imbalances and differences have been stripped away. There are still some differences, and I'll cover those specifically in the slides. When a client comes to me and asks or tells me that they wish to acquire property in the UK, the first question is why, because the answer to that will determine the holding structure. And in tax, as in life, there are very few absolutes and very few bright line tests, but here is one for free to start with, which is that if you're buying residential property for personal use, then never ever buy via a corporate. Residential property for personal use, i.e. used by the owner, used by the ultimate beneficial owner, or indeed a family member. If you've got a corporate involved, then the tax issues are going to be significantly worse than if you bought direct. And in particular, we have a couple of points. Firstly, the stamp duty land tax. Stamp duty land tax is our transaction tax, so it's a tax which is paid whenever someone acquires land. It's paid by the buyer, and if a corporate acquires residential property, and that residential property is going to be used by the owner or a member of their family, even if a rent is paid, then you have a very penal rate. The rate is 17% of the purchase price, which is significantly higher than you would pay if you acquired as an individual. So that's the first sort of thing which would dissuade you from acquiring via corporate. And the second, we have something called ATED, the annual tax on enveloped dwellings, which is effectively a wealth tax. The UK does not have a wealth tax except in this very limited situation where a residential property is acquired by a corporate and then there is personal use. Then there's an annual wealth tax. Rates vary because of the way it's calculated, but the rate is up to about 1.4%, depending on where you fall within the table. So residential property for personal use should always be bought directly. Leaving that one aside and just saying, if the property is going to be acquired for rental or is going to be acquired for development, then a corporation or an LLP is much more usual. And there are some differences, as you'd expect, in the tax implications, and I'll sort of run through those as we get to them. Very broadly, SDLT, so the transfer tax on acquisition, the rate of that tax is always paid by the acquirer of real property in the UK. That the rate is up to 5% for commercial property and up to 15%, but it's sort of it's a sort of there are different marginal rates, so your effective rate might be considerably below 15%, but the top rate is 15% for residential property. So there's a significant mismatch, obviously, between those two rates, and identifying which one you fall into is critical. This is a very much a sort of grey area, or an area that the tax authorities in the UK are focusing on. If you can argue that there is a commercial use to your property, so for example, if you're buying a large house with farmland attached, for example, if you can argue that there's some commercial use in the farmland, then you might to argue a significantly lower rate of transfer tax on acquisition. One of the areas in which UK residents differ from overseas residents is the last point on that slide, which is that a surcharge of 2% for purchases by non-residents is going to be introduced from the 1st of April this year. So together with some other tax relief lapsing, getting a property purchase completed by 1st of April 2021 is actually a big thing at the moment in the UK. The government has introduced that surcharge to fund rough sleeping to help the homeless, and they sneaked out some estimates when they brought in the legislation in early last year, and it's estimated to raise minus 255 million in additional sort of funds for the homeless, because it's expected to significantly depress overseas investment into the UK. So that is a key point to bear in mind. Also worth bearing in mind is that there are differences between the rates. While we perhaps sort of show to the world a very happy, friendly face that we're all one happy nation in the UK, actually we do fall out occasionally. And Scotland and Wales have their own transfer tax regimes, which are called different names and have increasingly divergent rules. The rates are typically slightly higher, but they are not going to implement the 2% non-resident surcharge. So it works out about the same, but it is worth bearing in mind that if you're in Scotland or Wales, then you have to consider the sort of local transfer tax regime. A key question which a lot of our clients ask us is they say if they're acquiring property which is already owned by a corporate, so if the property is already owned by a special purpose vehicle or a corporate, should they acquire the property or should they acquire shares in the corporate? If they acquire the property, it's cleaner, much cleaner transaction from a corporate perspective, but you've got potentially very significant stamp duty charges, up to 17% for non-residents. Whereas if you're buying shares, stamp duty is capped at 0.5%, so there is quite a large tax saving there if you're acquiring shares in a corporate. So typically, that's the sort of thing that needs to be looked at very carefully. There are three sort of dissuading factors which might lead you to prefer to just eat the higher stamp duty charge. One of those is commercial issues, of course. So if there are legal issues in the corporate that you're buying, perhaps there was staff involved, perhaps there might be litigation, perhaps there might be problems with construction that you'll be inheriting if you acquire a company. But then on the tax side, there's the issue of change of use. So where a corporate, or indeed any individual, any owner, changes their intentions over the use of a property, you potentially have tax issues. And particularly if you have a developer that has been building property, then they will have been holding that property as a current asset, i.e. work in progress or stock. If that corporate then changes its intentions to investment and to holding for rent, it is deemed to dispose of the property for market value. And so you've got a dry tax charge when you sort of mark the property to market. And so this happens very, very often where a client will be looking to acquire a property via a corporate. The corporate is holding it at stock. So yes, okay, we have a stamp duty saving, but we have a corporation tax charge. Current rates of corporation tax in the UK are at 19% on the change of use because our client wants to rent the property out. So you need to factor that into your price negotiation. And the third one is potentially VAT clawback. And here I'm just going to wheel in Sean, if that's okay, just for a moment to talk about what that might be. You there, Sean?
I am, Adam. Thanks. Yeah, thanks for that. I mean, as Adam says, from a VAT perspective, there are different treatments, whether you buy the shares in a company that owns a property or whether you buy the property directly. And the issue here, and we'll look at some of the other ones later on, the issue here is that if you buy the corporate, you inherit the VAT, so the indirect tax history of the property with the corporate. And if you, as the new owner, much like from a corporate tax perspective, if you change the use, then you can in fact suffer a clawback from the UK tax authority of the VAT that the previous owner has recovered. So it's something that we always recommend is fully consider that diligence. If a corporate's going to be acquired, is what is the VAT history and what is the potential liability if you decide to change the use from what the existing owner has used it for. So it's a very important point. And more on VAT later, so I'll hand back over to Adam.
Thanks, Sean. Okay, so looking at taxes which apply when property is owned, rental income is taxed, as I said, at corporate tax rates, currently 19% in the UK, whereas if the property is owned and rented out by an individual or, for example, a partnership or limited liability partnership with an individual owner, then the marginal rate of tax can be up to 45%, so significantly lower rate of tax for corporate owners. For a non-resident owner, there is a withholding tax of 20% on rents paid to non-residents. This is called the non-resident landlord scheme. It is possible, in fact, relatively straightforward with a bit of paperwork to get out of that so that your tenants do not have to withhold tax on the rent that they pay you. It's just something that needs to be factored in and dealt with immediately when the property is acquired. interest costs. So if the property's been acquired with leverage, then that can reduce the UK tax position quite significantly. There are restrictions if interest costs are very large, but mainly for individual owners, those kick in quite early. They kick in at once you get to about £50,000 worth of rental profit, then your ability to deduct finance costs is considerably restricted. For corporates, it's a much higher level. So you need to be sort of above £2 million a year of interest costs before you start to get into significant restrictions. So again, if you're buying it using leverage, then a corporate gives you a better tax position. Worth bearing in mind that interest paid in respect of a loan to acquire UK property will be probably considered to be UK source interest by the UK tax authorities, and that means that if you're paying to a non-UK lender, paying interest to a non-UK lender, there may be withholding tax. So, for example, we have an issue at the moment where one of our clients is a Jersey company and that has borrowed money from Dubai to acquire a UK property, and so there will be UK withholding tax on that, on interest paid on that loan, even though both parties of the loan are non-UK resident. There are ways around that, potentially a double tax treaty, perhaps exemptions in legislation, so some banks qualify for exemptions, for example. And also there's something called a quoted euro bond, which is a way of dealing with withholding tax obligations on interest, and effectively requires you to list the debt on a stock exchange. But again, you can do that for relatively small loans, and it can be quite tax efficient. But worth bearing in mind that UK property is subject to UK death taxes. Current rates are 40%, although people have nil rate bands of 325. So, if you've got property worth £425,000, then you're looking at £40,000 worth of inheritance tax on death. If you have that property in a corporate, then there's a look through. So for example, shares in an overseas company which owns UK property can be subject to UK inheritance tax charges. On sale, normally non-UK residents are not subject to any UK capital gains tax shares or anything. So if you sell shares in a UK company and you're not resident here, you don't pay tax on it. Until quite recently, that extended to capital gains, but now capital gains are within the UK tax net. Corporates pay 19%. Individuals usually pay 28% on their capital gains. There are some exceptions to that, but they're usually 28%. And also property-rich companies. So if an overseas individual sells an overseas company, and that company is property-rich, i.e. more than 75% of its value is attributable to UK property, then that share sale can also be subject to UK tax. And finally, in this section is just a pointer to say that there is no withholding tax on dividends for UK companies. So if you have a UK corporation that owns property, you sold it, you pay your tax, then you can extract it without any UK tax charges. And that's it for me on the direct tax section. I'm just going to hand now over to Sean to talk about VAT.
Thanks, Adam. Let me just move the slides along. So I'm just going to do a quick canter through some of the VAT considerations. So value-added tax, which is the UK's indirect tax, which applies through the supply chains. It's not identical to some of the sales taxes that exist. Hugely important for property transactions, certainly commercial property transactions, but also some developments of residential projects, because the tax applies at a rate of 20%. So if it's not sort of baked into budgets or it's not considered in terms of whether it's recoverable, then it obviously has a huge impact on the viability of a project. So I think my key takeaway for everyone, we'll look at some of the detail, but the key takeaway is please do consider the VAT position before any UK property acquisition, because it can wipe out profit, certainly in a development, or it can wipe out investment growth very, very quickly. So I'd say the key rate of the standard rate in the UK is 20%. We do have some reduced and zero rates that will apply to construction projects as well. So again, we're looking out for that. The position, and we'll look at shortly, the starting point for commercial properties is that they are what we call exempt from VAT, which creates an issue around future VAT recoverability, but there is an option in the UK to make those transactions what we call taxable, so subject to VAT, and it's something that certainly I advise on every day as to whether that is the correct option for people or not. And the important point for the non-UK participants on the call is the VAT applies to land and property transactions, whether you are a UK resident or otherwise. So it's very important for non-resident buyers or investors to consider the implications. So looking at residential property first, existing residential property purchases are exempt from VAT, as Adam says. For other tax reasons, the advice is do not buy those in a corporate, but if you do purchase a residential property in the UK, either for your own use or for letting, then it is going to be exempt from VAT, so no VAT cost. But equally, if you then run a residential property letting business, you will not get any VAT recovery on any costs of refurbishment, repair or renewal. So it's well worth, if you have that sort of project, it's well worth considering whether any 5% is available. The major difference between buying an existing property and buying a new property is that the new property is what we call zero rated. Now, this is where people start to get maybe confused between the terms, because in both cases no VAT is charged. One's exempt, no VAT. One's zero rated, no VAT. But the advantage, certainly for the developer, of the zero rate is that it means that VAT is applicable at 0%, which gives it VAT recovery on cost. So if you're ever buying a site to carry out a residential development and VAT is charged on that land, then if you sell those units, you get VAT recovery on the cost. So majorly important point around how you budget for these transactions. Moving on from residential, commercial properties, either buying them or renting them or leasing them is exempt by default unless you're buying the freehold in a new property. So buying new is less than 3 years old, property is less than 3 years old, and you buy the freehold, that's automatically subject to VAT at 20%. As I say, the downside of making an exempt sale for the seller is that they don't get any VAT recovery on costs. So there is this piece of advice that we go through with potential new owners of properties is do they look to opt to tax the property, so charge VAT on the rent or charge VAT on the sales proceeds, because that will give them VAT recovery on costs. And it's back to that point that Adam raised, that if you are buying a corporate that's got a property in it, or you're buying a property and inheriting the historic position, is opting to tax the right thing for you to do. Certainly can be in most cases, but something that should be considered. We said there at the bottom that obviously if you do opt to tax a property, then it increases the sales proceeds by 20%. So you're adding consideration, and the effect of that is if you sell it, is that it increases the stamp tax that's payable, the land transaction tax. So there's potential ways of structuring it that will reduce another tax. So the SDLT in England as an example. And by charging VAT on a property, it tends to increase the transaction tax by 1%. So it's for a significant purchase, it's well worth seeing whether this structure can be used, and it's again frequently is used in the UK. And just finally, just looking at some speciality assets, student accommodation, care homes, we advise a lot in this space. They are quite popular investment assets for overseas investors, as well as hotels. Again, we've got a number of clients who are offshore who invest in hotel chains. Now, I would just really raise the issue that if you are buying or looking to invest in student accommodation, or you're looking to buy existing student accommodation or existing care homes, then be very careful around the VAT recovery position and what you're buying, because again, you can trigger a historic liability that you have not had any benefit of, and then you end up incurring significant amount of VAT, which can be 20% of the value of the asset, and that becomes a sunk cost. So again, my takeaway here is if you are looking at investing in these assets, please do make sure that you consider the VAT position as early as possible. And finally, I would just say that Adam and I obviously advise on different taxes, but we work on these projects together because sometimes a solution for VAT will create an SDLT or a corporate tax problem, and sometimes the trade-off between having to pay slightly more of one tax to save on the other, and it's something that requires a sort of holistic view to make sure that the correct tax position is being achieved. So just a quick sort of canter through our taxes here in the UK. I'm just going to hand back over now to David and Nathan, who are going to discuss some of the Canadian issues. And quite interested to hear how similar or otherwise they are to the challenges we face in the UK. So I'll hand back over now.
Thank you, Sean. That was awesome. So just, listening to what you were saying, you should know that a lot of what we're going to talk about, it's funny just to hear what you guys were saying, because a lot of the rules that we're going to be talking about today in Canada are very similar. Obviously they're not exactly the same, but, a lot of the ideas behind the laws are extremely similar. So before I start, I just want to let you all know that we'll be saying lots of information, but if you have any questions, please ask after, or, put a question in the question box. If you want to call us after, send an email, that's fine, because every situation, it depends on the actual facts. And so this is a very good, guide, but it's important just to get down the facts to see what is the right solution for you. So we're just going to be talking about really the entire life cycle of owning a property in Canada. And we're going to be talking about, well, first of all, what does it mean not to be Canadian for income tax purposes? There's going to be laws that you have to know about when you're actually making a purchase of the property. And then when you actually hold the property, you'll be, collecting rent. And there's a lot of red tape and rules and planning opportunities that you should know when that happens. When you sell, there's a lot of stuff to know. People often sell property in Canada if they're not Canadian, and they find out after the fact they didn't follow the rules. And if you don't follow the rules, it could be extremely punitive. So we're going to be talking about what the laws are and what you should know when you're selling. And then we're going to be talking about fees just to be aware of in Canada, whether it be mortgage costs, real estate, commissions, or insurance. And now I'm going to pass it on to Nathan.
Thank you, David. So I'm going to discuss what it means to be a non-resident in Canada. When you're in Canada, you're taxed based on your residency, not your citizenship. So you could very well be a Canadian citizen, but not taxed in Canada. To be a non-resident in Canada means you do not have significant residential ties to Canada. Residential ties are broken up between primary and secondary factors. Primary factors include a house in Canada, a spouse or a common law partner in Canada, or dependents in Canada. Secondary factors include personal property that are here, such as cars or furniture, social ties to Canadian recreation or religious organizations, or economic ties to Canada, such as bank accounts or investments in Canadian broker accounts. Other factors also include a driver's license, a Canadian passport, or any provincial health insurance coverage that you may have in Canada. The Canada Revenue Agency, or the CRA, will look at all these factors in totality to determine whether you are a resident in Canada. But note that if, in fact, that you think you are not a resident in Canada, if you happen to be in Canada for 183 days in any 12-month period, the Canada Revenue Agency will deem you to be a resident in Canada. For a corporation to be non-resident means that it has to be incorporated outside of Canada, and the board of directors operate in a jurisdiction outside of Canada. So if you're not a resident in Canada, you're not taxable in Canada. But unfortunately, when you do own property in Canada and earning rental income from it, or earning or sell that property, you are taxable on that particular property because they consider you to be carrying on business in Canada. When you're buying a property, it is best to determine what you will be using the property for. And based on that, we can determine what is the best vehicle to buy that property in. If it's going to be a personal use property, such as a cottage with no income-producing purposes, then we would highly recommend that this be bought personally or through a trust. Generally, after you buy the property and there's no income-producing purposes for it whatsoever, There are no annual filings for income tax purposes. The only tax filings you would need to do is at the time when you do sell the property. The disposition of property could be done by a gift, a sale to a third party, or transferred to the next generation upon death. Again, we highly recommend that you do not buy this in a corporation, as selling the property may present some tax issues to you, and is generally not advisable when you sell the property. If you intend to buy the property to develop and sell the property, or develop and rent the property, or buy an existing property that already has a commercial property on that you wish to rent, or a residential property that you wish to rent, we would recommend that you buy this through a Canadian corporation to buy the property. The Canadian corporation, or CanCo, can buy the property either directly or through a joint venture or partnership. And the Canadian corporation will file an annual tax return to report and pay taxes on the income earned on that property. If it is decided that you want to buy this through a non-resident corporation, this is fine also. The tax filing requirements are the same. You will pay the exact same corporate tax rates as Canadian corporation. The only difference is that you will have an additional branch tax, which is similar to, it tries to simulate what the withholding tax would be on the dividend, because with a non-resident, you're getting the money directly back to the home country without paying the withholding taxes via a Canadian corporation. So it tries to level the playing field there. Another issue with holding a property through a non-resident corporation or through a non-resident personal person is that there are withholding taxes, and we will talk about this further in a subsequent slide. When buying property, like I said, there's several vehicles which you can buy the property in. You can buy the property personally. This will offer you no liability protection. So if someone slips and falls on your property and sues you, there's no limited liability with respect to owning it personally. You can buy it through a corporation, either a Canadian corporation or a non-resident corporation. This offers liability protection. And like I said, with a non-resident corporation or owning it personally, there are withholding tax requirements on the receiving of the rent income or on the disposition of the property. Whether you buy it personally or through a corporation, you can also buy it through a joint venture or a partnership. Joint venture or partnership, they're not separate legal entities. What you would do is you pick up your share of the profit of joint venture or the partnership and pay taxes accordingly. Another vehicle that you could buy a property in is an unlimited liability company, or ULC. We won't discuss this in much detail because these are mainly used by U.S. corporations because of their flow-through properties. So, for example, if the company has a loss or the ULC has a loss, it flows through directly to the members of the ULC, and they utilize that losses directly. It's not trapped within the ULC. Note that, as the name suggests, any liability that could come from that company or the ULC is unlimited, so it offers you no liability protection. Excise tax and provincial sales tax is very similar to the VAT in Europe. We have the GST and HST, which stands for the Goods and Services Tax, and the Harmonized Sales Tax. The GST is administered by the Canada Revenue Agency and is 5%. And the provincial sales tax is administered by the various provincial ministries, and they range from 0% in the province of Alberta to a high of 9.975% in the province of Quebec. Depending on the province, if the province chooses to, it can harmonize their provincial sales tax with the Goods and Services Tax, and it's hence called the HST. It follows the exact same rules as the GST, it just combines the HST and the provincial PST together. And the HST ranges from 13 to 15% depending on the province that you're in. When buying a property, you must be aware that there are land transfer taxes on the purchase of the property. And Alberta, Saskatchewan imposes a small transfer fee instead. Land transfer tax can range from 0.5% to a full 5%, and these are paid upon closing of the transaction. Note that in the province of Ontario and British Columbia, there are additional taxes, or land transfer taxes, for speculative buyers, foreign buyers in particular, because in the province of Ontario, there's the city of Toronto, in the province of Ontario and the city of Vancouver in British Columbia, which were going through some significant spikes in prices of residential houses. So that's why these foreign purchaser taxes were introduced to help calm down those markets and keep the prices in check. And I pass it back to David to discuss about holding investment properties as a non-resident.
Thank you, Nathan. So now, the person went and they purchased property. They could have bought a house, they could have bought a building, a shopping mall, and now they're going to start to collect rent. So to keep it simple, let's say that, you are going to earn rental income of $1,000 a month. Well, the rule is that, you need to withhold and send in to CRA 25% of that every single month. So of the $1,000 of income, of the gross income you earn, you would only be left with $750, which is, people, when they hear about this, they're like, what? I'm crazy. Why can't you deduct expenses? So if you want, you can go to CRA and you can ask them for permission to withhold on the net. So based on my previous example, if you were earning, let's say, rental revenue of $1,000 a month, and you have expenses, let's say you have your utilities and your property taxes and all of that, and at the end of the day, your monthly net income is only $500, you only really need to send in 25% on the net. Now, CRA tracks this, and at the end of the year, you'll be able to see how much withholding tax was actually sent in. And if you decided to withhold on the net, you would need to file a return every single year. If you're a corporation, you would be filing something that's called a T2. If you're an individual, you'd be filing a T1. And these returns are due June 30th of the following year. I should say that the withholding taxes, if, for instance, you earned the rental income in say, January, they're due the 15th day of the following month. So they'd have to be sent into CRA by February the 15th. Now, that's very complicated. No one wants to worry about, withholding taxes and having to send in money and tracking it. So what we often say is it's much easier to become a Canadian corp and purchase your property through a CanCo. If you're a CanCo, even though the owners of the CanCo or the CanCo might be controlled by people that are not resident in Canada, because the corporation is actually a Canadian corporation and is based here, it would be considered a Canadian company. In a Canadian company, withholding taxes don't apply, and you're going to be paying income tax at pretty much a flat rate of 25%. Now, depending on the province that you're in, it could be as high as 27%, it could be 23%, but the typical rate you'd be paying income taxes on the net rental income would be approximately 25%. A question that we get often is, well, let's say in a specific year, the property was vacant a bit, or the expenses were very high, and you actually had a loss. So your expenses in that year exceeded the revenue. So for instance, let's say you had revenue of $1,000 and your expenses were $2,000, so you'd have a loss of $1,000. Well, no one wants a loss, but if worst case, you can carry forward that loss. So in the next year, you had profit of $1,000, you'd carry forward that loss and you wouldn't have to pay tax in the following year. Alternatively, if people don't want to wait and see if they have profit in the coming year, what they can do, and what we often do, is that if they had losses in a previous year, you can carry it back. So if you had, let's say, $1,000 of income in 2020, and you had, let's say, if you had $1,000 of loss in 2020, and you had, let's say, $2,000 of income in 2019, and you pay tax on that, you can carry the loss back, and you'll actually get a refund on the taxes that you paid in prior year. Just note that losses carrying forward go for 20 years. If you want to carry a loss back, unfortunately, they aren't as kind. You don't get 20 years. You can go back 3 years. If you own the property as part of a partnership or a venture, everything pretty much applies, and you'll be paying tax, or these rules just apply to the percentage that you own. So if you own 15% of a property, these rules apply, and it's just that you'll be paying tax on 15%. So every year we of course have to worry about the income taxes, but just like we were talking about before, we have sales tax. So if you own a property and the property is for residential rent, the general rule is that if the lease is greater than 30 days, you don't need to charge HST or sales tax. So if you're collecting rental income per month of $1,000, that's it. There's no other expenses that the tenant or there's no other taxes that the tenant needs to pay. But if the general rule also is if the lease is for less than 30 days, so you sign a lease for a week or two, you're going to a cottage or you're going up north or somewhere, and you only sign a lease or an agreement for a week, well, that's really not considered residential rent. It's more seen like a hotel per se, in which case you would need to charge the HST. Like we said before, depending on the province you're in, the sales tax could be anywhere from 5% to really as high as 15%. Like we were just saying before, commercial rent, so if you own a plaza or let's say a shopping mall, so if you have a tenant in that mall, they would be considered commercial tenants, and they would need to pay the HST sales tax on that rent. But the good news is that if you're one of the individuals that own property that needs to collect sales tax, just like they were talking about at the VAT, you are able to actually get back the sales tax that you pay out. So to keep it simple, if you earn in a specific year, let's say sales tax of $1,000, and then you go and you pay sales tax because you bought, let's say, furniture or a computer or anything, you can actually get that back. So you would not need to remit to CRA $1,000. It would be the $1,000 minus the HST that you pay. And not only that, but sometimes it could happen that the sales tax you pay out exceed the sales tax you collected. So your expenses for sales tax purposes increase your cost, and you're actually able to apply for a refund. Okay, so we've been talking about buying and holding, renting. Now it's time for the sale. You bought the property, you're shocked, the property went way up in value, and now it's time for the sale. So if you're selling it in a Canadian corporation, it's generally considered, when you sell an investment property, it's generally considered to be a capital gain. And a capital gain is 50% taxable in Canada. So if you bought a property for let's say $1 million, and you're selling it for $2 million, your capital gain is going to be $1 million. Now you're only going to pay tax on half of that. So $500,000 of the capital gain is free. You don't have to pay tax on that, and the other half you would have to pay tax on. The tax rate in Canada for that type of sale, if you're a Canadian corporation that's controlled by a non-resident, is 26%. So it would be 26% on the 50% portion, or if you look at it from the larger picture, we're talking about 13% tax on the actual gain. Now, talking to other accountants, like in different countries, I think that the capital gain tax rate in Canada for a corporation that's not controlled by Canadians is probably one of the lowest in the world. People always complain that for Canadians that actually live here, the rates are very high. But clearly, if you're not living here and you invest through a Canadian corporation, it's kind of nice to see that the tax rate isn't that high. Now, if you own real estate in Canada, but it's not held, you didn't buy it for an investment, so you bought it to let's say flip or develop. So you're in the business of actually buying and selling land or buildings. The tax rate is going to be 26%, right? So before we were saying it would be 26% at half, which is 13%, but in this case it would be 26% in Canada. So that's if you're selling as a Canadian corporation. What if you decided to buy a property and you decided not to incorporate? Well, the property in your personal hands will be taxed as a capital gain, and depending on the amount of the profits and your personal tax rate, that gain will also be taxed at half. The top rate in Canada is right now it's about 53.7%. So you'd be taxed at half that. So approximately the top rate in Canada would be about 27%. And if your gain was very small, so you own part of a partnership or you only own part of a property, or let's just say you just didn't have a large gain on real estate in Canada, which would be very rare, your tax rate, depending on your province, could be as low as 11%. I'm now going to pass it on to Nathan to talk about the actual process of selling real estate as a non-resident.
Thank you, David. When you sell real estate in Canada, because you're a non-resident, the Canada Revenue Agency imposes a withholding requirement of 25% on the proceeds of the sale of the property. So the Canada Revenue Agency, because they have limited means to come after you because you are outside of Canada, they want the money up front. So they impose this liability on the purchaser of the property. It's the purchaser's responsibility to withhold 25% of the gross proceeds. If the purchaser fails to remit this, that's their problem. So let's say, for example, we have a situation where you're selling a property for $1 million, and your original cost for the property was $800,000. So you have a $200,000 profit on the sale of this property. Without any further steps, the purchaser would need to remit 25% of the proceeds, which is $250,000, which is in excess of your profit of $200,000, which doesn't seem right. There is a process in which you can have the 25% withholding reduced to 25% of the net gain on the sale of the property, just taking into account the cost of your property. So instead of $250,000, it'll be 25% of $200,000 profit of $50,000. So to go through this process, you must notify the CRA of this proposed sale. This should be done before the property is closed or the sale of the property is closed. And with this notification, you would send the proper documentation to support the proceeds and your cost base. Until this certification or clearance certificate is received, the purchaser will hold on to the funds, and you should discuss this with your purchaser to let them know that the clearance certificate is in process, and they will hold on to the funds until that clearance certificate is received. So it may create some cash flow issues, and some patience is required at this step. Even though the Canada Revenue Agency has a policy of trying to process the clearance certificate within 30 days, our experience is normally around 60 days to process a clearance certificate. And note that this 60-day period was pre-COVID-19. With COVID-19, with the CRA not having a full staff and everything, I'm not too sure what the processing rate would be nowadays, but it'll probably be more than 60 days. So patience needs to be exercised here. Once the clearance certificate is received, a copy is sent to the purchaser, and the purchaser will remit 25% of the net proceeds and will remit the balance to you. An important note is on the clearance certificate, they're withholding 25% of the net proceeds, and they only take into consideration the cost of the property, in our example, the $800,000. It does not take into account selling costs such as the legal fees incurred or the commission costs paid to sell this property. So we would recommend that you file a Canadian tax return for the period to properly calculate the appropriate net income on the sale of this property. And your taxes will be lower. The withholding that has been paid to the Canada Revenue Agency will be treated like a tax installment, and you can get some of that money back when you file a Canadian tax return by claiming some of these expenses. Next, we'll talk about financing, insurance, and legal fees. Financing in Canada, normally you need a down payment in Canada when buying property. Generally, lenders would like to see a 25% down payment. Non-residents are eligible for the same interest rates as Canadians, but in some cases, depending on the country you're from, they may have a rate premium included on that interest rate. The non-residents would need to meet the same mortgage eligibility requirements as Canadian residents, and if the non-resident lives in a country that we do not have a treaty with, they may only be eligible for fixed rate interest on their mortgage. Another thing to keep in mind is that in Canada, the maximum amortization period for a mortgage is 25 years, unlike some jurisdictions such as the United States where they have 40-plus years of amortization period for the mortgages. So the monthly mortgage payments may be a little bit higher than you may be used to in Canada. And I pass it on to David to discuss insurance.
Thank you, Nathan. So, let's say, a person corporation goes and they purchase a property, they spend millions of dollars on it, they pay legal costs and commissions and everything. And then they find out that the property that they own doesn't, belong to them. So somebody else, let's say, has title to the property. So they weren't really able to purchase the property that, they own. Well, that is not something people, want to find themselves in. It's something that I've seen happen a couple times before. And title insurance is so important, whether it's a commercial property, residential property. You want to get insurance, and just to make sure that if somebody ever comes back to you and says that, hey, that property is not yours, or you weren't able to actually purchase it, well, you at least have insurance, and any claims or costs that are going to come at you, you're at least protected by. Okay, as well, residential and commercial insurance, very often you can't even start to own or rent out a property or actually live in a property until you have these insurances. These insurances, depending on the type of property, they will protect you from an earthquake or a flood, or if let's say a tenant slips and falls. It's very important to have insurance. I know in other countries, if somebody does sue you, the potential, the size of the lawsuit can be very large. In Canada, there are laws that really protect you, that the amount of the lawsuit that someone puts at you isn't as high as, let's say, in the States, but you still want to have, the insurance. So having insurance is important, and even if you don't want to have insurance, very, very often you won't be allowed to do anything with your property until you actually have that insurance. Professionals in Canada are very, very important. Sometimes people want to try and buy a property and not use a lawyer or not use let's say, I'm a realtor. And the expertise and value that these people can provide are so important, and it's definitely worth the actual cost. You want the lawyers to do the agreements. You want to make sure that nothing is missed. Very often, when you buy a property, there has to be a clause in there, and if you're buying a property for a specific reason, a specific use, and that clause isn't in there, you might get hurt. Afterwards, you might have had to charge, let's say, a sales tax that you didn't charge. It's very important that a lawyer looks at it. The realtors, whether they are for homes or for commercial properties, they're important. They understand the market. They are certified here, and they'll help you understand. They'll really knock down for you what your needs are, what your wants are, and they'll help you find the best place possible. If you're going to sell it, they'll help you maximize the value, and if you're actually purchasing the property, they'll definitely help you get the best deal. And the commission rates in Canada, I guess it depends on the township and the city and the province, but usually what we're seeing is the commission fee on a sale of a real estate in Canada is about 3 to 5%. So we've talked about sales tax, we talked about withholding taxes, land transfer tax, income taxes, sales taxes, taxes. There's another tax that people often don't consider. When they purchase a property, they realize that they're going to have to pay, the utilities on it, and there's all these costs and fees, management fees. But then there's also something that's called property taxes. And property taxes is a tax that you pay to the actual city or town where the property is. The tax in Canada, depending again on the province and the city and the town, can be anywhere between 0.5% to 2.5%, and the tax is based on an assessed value that the city has. So the city will come and they'll pretty much tell you what they think your property is worth, and they will make you pay taxes a percentage of that value. What we usually see is that the value the city or the township puts on the property is actually low. So people are surprised when the city assesses their home or their like a building at a specific amount when they believe that it's worth much higher. The realtor will tell you like what it's worth. Don't listen to the city when you want to know what the property is worth. It's just their way of assessing value for what how much you should be paying property taxes. Lastly, if you don't pay property taxes or if you're late, there is penalties and interest. And penalties and interest don't only apply to property taxes. We haven't really talked much about it in this presentation, but if you don't pay your taxes on time, you don't file, there's interest and penalties for everything: withholding taxes, sales taxes, income taxes. So it's important that no matter what the taxes that you're paying, that you do your absolute best to pay that tax on time. So thank you so much for listening. We're now going to take some questions. People have been putting in questions during the presentation. I'm going to call back Sean. I'm going to call back Adam and Nathan, and we're going to look at some of the questions that we have. So one of the first questions that we have is actually a very good question. What if you have a Canadian corporation, but its board isn't based in Canada? Or what happens if let's say the president is based in Canada and the secretary is in the States? So that's a very good question, and really as we look at the control, okay? So if in that typical case, and there's a lot of cases on this in law and stuff like that, but if the company is not controlled by a non-Canadian, so because in the case that let's say that 50% is Canadian and 50% is not, it's still considered not to be a not Canadian controlled company because you don't have more than half of the board outside of Canada. That would then consider to be a Canadian residence corporation. But again, there's a lot of cases on this, and the facts are so important. How many people are on the board? Who can vote? Are the shares, voting shares? Are they minors involved? So that's a very good question, and please feel free if you have any more follow-ups to ask us. We have a question for Adam that you mentioned that a transfer surcharge of 2% of purchases applies, but what if someone that's not from the UK incorporates a UK company? Does the 2% transfer tax surcharge apply?
And unfortunately, yes, it does. So non-residents for the transfer charge. Again, you're looking at ultimate control. So if you've got a resident seeking to reduce the level of transfer tax incorporated a UK company, just look through that and say, okay, well, in this case, it's controlled by overseas shareholders. So unfortunately, this still applies. For very large companies with lots of shareholders and quoted companies and stuff, that there's an exemption. But otherwise, you look at it.
Okay, thank you. Nathan, I have a question for you. That if a rental property in Canada is a vacant, are you still able to claim expenses on it?
You are able to claim the expenses on it. Probably for the next couple of years. What the Canada Revenue Agency will look at is whether you have an expectation of profit on this particular property. If you consistently have losses and it's being vacant all the time, they may question whether you have the proper business activity. Are you actively looking for someone to rent the property? And there must be some extenuating circumstances why you don't have a tenant. But if it's just for like a year or two, you're fine. If it goes beyond that, you have no tenant beyond 2 years, you should probably relook at that, whether you should be claiming those expenses in the third year or not. So again, it depends on the situation and the factors.
Okay, Sean, a question for you. Has Brexit changed that treatment on property acquisitions?
Yes, it's a good question because VAT is historically and still is a European tax. But what has effectively happened is that the UK government, following us leaving the the EU and the end of the transitional period on the 31st of December is we've just transplanted the European law, and certainly in respect of VAT on property, have transplanted the law into UK law. So yes, it will continue to apply as it did before the 31st of December.
Okay, thank you for that. And I guess we have time for a one final question, and this is a question that we actually get often. Let's say you are Canadian and you live right here and you own properties, and then you emigrate. So you move, let's say, to the UK. So what happens then? So pretty much the general rule is from the day you actually leave. So let's say you were living in Canada up until December 31st, and you moved to the UK in January. That's the official departure date. So all of these rules will apply to you starting on January 1st. So you really have to kind of get with the program quickly, because on a certain day you are not part of it, and then the following day, okay, you are. So it's just important that you're pretty much up to date on all of this. And very often people don't realize that the rules apply, and you don't want to wait too long. You don't want to find out let's say a year late, and you were supposed to collect taxes this whole time. The penalties and the interest are quite punitive. So it's definitely something you should really do your best to get this all arranged and the affairs in order prior to departing Canada. Okay, so I want to thank Safferys. I want to thank Adam and Sean, Nathan. I want to thank all the people that helped put this together. I want to thank all of you for joining us. And I know we spoke about a lot of stuff, and please feel free at any point in time today or tomorrow or in February, whatever. If you have any questions or anything that comes to mind, please feel free to call us or to email us at any time. We'd be more than happy to answer your questions. So, have a wonderful day. Thank you, and we hope to be in touch. Take care, all. Thank you.
Bye, everyone.
Thank you.